Hey everyone, welcome back to Corporate Decoder F.T.A.I Infrastructure. Incorporated just filed a Form 8K revealing a new bridge loan, and I'm seeing a key detail about its repayment that signals something interesting. Quick note, this is not financial advice, just my take on public filings for educational purposes. This new loan is for a hefty amount, and how they plan to pay it back tells us a lot about their strategy moving forward. Alright, let's dive into this filing from F.T.A.I Infrastructure Incorporated. They've announced a new material definitive agreement, which basically means they've entered into a significant contract. What has really caught my eye is this bridge loan credit agreement. On the 1st of July 2026, a subsidiary called Jefferson 2020 Bond Borrower LLC, or the borrower for short, signed a deal for a secured bridge loan facility totaling $230 million. This loan is set to mature on the 30th of June 2027. Now, bridge loans are typically short-term loans used to cover immediate financial needs until a company can secure more permanent financing or until certain assets are sold. So, what are they doing with this $230 million? A big chunk of it, specifically $217 million, was used to pay off existing bonds, the Taxable Series 2024 B bonds issued by the Port of Beaumont Navigation District of Jefferson County, Texas. The rest of the money went towards funding a debt service reserve account, required by the new loan and covering fees and expenses related to these transactions. Now let's talk about the cost of this money. The interest rate on this bridge loan will be based on the adjusted term SOFR rate plus a margin of 5.50% per year. Here is where it gets interesting though. This margin actually increases by 0.5% every 90 days after the loan started. This is called a step-up interest rate, and it's a way for lenders to be compensated for the increasing risk over time, or to incentivize faster repayment. But the most crucial part is how this loan is expected to be repaid. It is not just a simple maturity date payment. The borrower is obligated to repay the loan using the net proceeds from things like certain asset sales, recovery events, and importantly, issuances of certain equity or debt. This tells me they are planning to either sell off assets, or raise more money through stock, or more debt to clear this bridge loan. On top of that, there is a requirement to make prepayments using what is called excess cash flow. This means any money left over after operational costs and other obligations must be used to pay down this bridge loan on specific dates in 2026 and 2027. This suggests a focus on deleveraging relatively quickly once there is surplus cash. Like most loan agreements, this one includes standard clauses. There are promises about how the company will operate, known as affirmative covenants, and importantly, limitations on what the company can and cannot do, called negative covenants. These restrictions typically cover things like taking on more debt, paying out dividends, making new investments, or putting up assets as collateral. These are in place to protect the lenders. One specific requirement is maintaining a minimum of $20 million in liquidity while this loan is active. This is a critical buffer to ensure they can meet their immediate financial obligations. And of course, there are events of default. If the borrower fails to meet certain conditions, like missing payments or violating covenants, the lenders could demand immediate repayment of the entire outstanding loan amount. This is a standard but serious consequence. This loan also falls under a larger existing agreement, the second amended and restated Collateral Agency Intercreditor and Accounts Agreement. This means the security and terms of this new loan are integrated with other existing financial arrangements and collateral. This section just reiterates that on the 1st of July, the Taxable Series 2024 B bonds, worth about $217 million, were indeed fully repaid using the funds from this new bridge loan. This item in the filing simply confirms that the creation of this new direct financial obligation, the bridge loan, is being reported to the SEC essentially points back to the details we just covered in item 1.01. Finally, this section lists the exhibits filed with the report. The most important one for understanding the nitty-gritty is Exhibit 10.1, which is the actual bridge loan credit agreement itself. We are looking at Exhibit 10.1, the full text of the bridge loan credit agreement. They've omitted some schedules and exhibits, which is pretty standard, but they've agreed to provide them to the SEC if requested. And here is the signature block confirming that F.T.A.I Infrastructure Incorporated, through its authorized representative Kenneth J. Nicholson, Chief Executive Officer and President, has officially signed off on this report on the 2nd of July 2026. So, what does this all mean for F.T.A.I Infrastructure Incorporated? They've basically refinanced or replaced one debt obligation with another, larger, and potentially more expensive one in the short term, given that step-up interest rate. The crucial piece here is the repayment strategy, relying on asset sales equity, or debt issuances to cover a $230 million loan within roughly a year can be a tightrope walk. If they can execute on those asset sales or capital raises successfully, they can manage this. However, if market conditions sour or their planned asset disposals don't materialize as expected, they could face significant pressure. The requirement to maintain $20 million in liquidity is a positive sign showing a commitment to operational stability, but the increasing interest rate is a clear signal that this is a temporary solution, and they need to move to a more permanent financing structure or generate substantial cash flow soon. The risk I'm watching is their ability to time asset sales or equity raises effectively in potentially volatile markets over the next year to meet these repayment obligations. What I'm actually looking for is clear progress on those asset divestitures or a roadmap for long-term financing. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. And if you found this helpful, give it a like, subscribe for more, and join our Discord community linked below.